Hi, it's Kirk Lynch again. This lecture is going to cover some selected topics from Chapter 6. It's a series of smaller topics. Chapter 6 mainly deals with the introduction of the merchandising business. Up to this point, all of our transactions have been based on a service business. And so when we move over to a merchandising business, we add some new accounts, some new topics that we're going to discuss. And so that's what this lecture will do, is introduce each of those things. So the new accounts that get introduced in the merchandising business are highlighted here in kind of a gray color. But mainly they are merchandise inventory, which is a new asset account. That's all the stuff that we would be selling in our retail store. Sales is now the name of our revenue account. We go from fees earned to sales. And the other new account here that's highlighted is called cost of merchandise sold. So in a merchandising business, we don't manufacture anything. We go out and we buy stuff that other people make. And whatever that stuff is that we buy, it costs us something. And so that's what our cost of merchandise sold represents. So as a general rule in a merchandising business, we go buy that stuff at a certain price and we put it on our shelves and to resell it, and we mark it up above that price, and that's how we make our money. The difference between what it costs us and what we sell it for is known as profit or gross profit. So recording those sales requires some new journal entries now. So when we sell inventory, we see an example here of a journal entry, and in this case, we're going to sell something to a company called Mount Evans Supply, and we're going to charge them $500. We're selling it to them on account. If we were receiving cash, we would replace the debit accounts receivable here with our asset account cash. So when a merchandising business records a sale, it requires two different journal entries. One to record the sale and the receipt of either cash or accounts receivable, and two, to update our inventory with the amount that sale cost us when we purchased it. So here we see those journal entries. We're going to debit accounts receivable. The name of our customer is Mount Evans Supply. We're charging them $500. We're recording our revenue from that sale in the sales account, crediting $500. The merchandise that we are selling cost us $300. So the second half of this journal entry, we're going to debit the new expense account, cost of merchandise sold, for $300. And we're going to reduce our inventory by $300 with this credit to our inventory account. So that summarizes a journal entry to record our new sales process here with a merchandising business. In an earlier video, we had outlined building a multi-step income statement, and in that video we used some of these accounts from a merchandising business, including sales, cost of merchandise sold, which gave us something called gross profit. And so in your Chapter 6 quiz and in your Chapter 6 homework, you may be asked to calculate gross profit, and it's simply our sales number less our cost of merchandise sold. In this particular transaction, if we were just calculating gross profit on this one sale alone, it would be $500 minus $300 for our gross profit of $200. I would also encourage you to go review that video that's on multi-step income statement if you need to create a multi-step income statement. It's a rather long, detailed process, and I don't want to take up all the time to repeat it here in this video. Just go watch that video. Now, the other side of our merchandising business is, of course, we sell inventory, but we also have to purchase that inventory. And so the journal entry to record the purchase of inventory would look something like this. So in this case, we're going to buy from a supplier named Longs Peak Supply, and we're going to buy some inventory from them on account. And so here we would see we would debit our asset account merchandise inventory for $2,500, and credit accounts payable to Long Peak Supply for $2,500. So that's a pretty straightforward journal entry, but one that's basic that you're going to need to be able to do. So two sides to a merchandising business: a sale, which involves journal entry, and a purchase of the inventory. All right, new topic from Chapter 6, discounts. Okay, so frequently you may see the notation that you see here bolded 2/10, comma, N/30. That's pronounced as 210 net 30. And what it means is if you will pay us within 10 days, you can receive a 2% discount. Otherwise, you owe us the full amount within 30 days. Those are the terms that we offer to our customers, for example. The one below it, highlighted, 3/15, comma, N/60, would be termed as 3/15 net 60. In other words, if you pay us within 15 days, you can take a 3% discount. Otherwise, the full amount is due within 60 days. So these discounts offered by suppliers are to incent buyers to pay them on time or early. One of the biggest problems that small businesses face is cash flow. And so this is a way to improve your cash flow by incenting your customers to pay you quickly, and in return they get to take a discount. Now, if you are a buyer and you are offered these discount terms, it's highly recommended that you take advantage of this, because a 2% discount in 10 days would be comparable to, let's say, 20 or 25% interest over the year. So it's worse than paying a high credit card rate if you don't take advantage of these discounts. So all buyers and sellers, when there's a discount available, they're going to take advantage of it. So now, when you record a sale that involves a discount, there are two ways that it can be done. One is we can record the sale or the purchase at its gross amount, and then once the payment is received or sent within the discount period, you make an adjustment to the transaction to reflect the discount. That involves two different journal entries at two different times. A simpler way is the second option, which is to assume that the discount will be taken within the discount period, and you record the sale or the purchase at the discounted amount, and then when it's paid within the discounted period, there's no adjustment that needs to be done. By the way, this is the way that we currently use in our textbook and other problems that we are working. We assume that the discount will be taken, and we record purchases and sales at the discounted amounts. Here we have an example of that same transaction that we did earlier, where we sold some stuff to Mount Evans Supply, and we've added in the fact that we have now a discounted term available. Remember, our gross sale to Mount Evans was $500, and our cost of merchandise sold was $300. And so if we would throw in the option of a 2% discount, we would record that sale this way. We would debit accounts receivable for Mount Evans Supply. A 2% discount on $500 equates to $10, and so the amount that we would expect to collect is $490. We record our sales at that discounted amount as well, $490. The second half of this transaction doesn't change. Our cost of merchandise sold, regardless of whether we offer a discount or not, is still the same. We paid $300 to buy this merchandise that we're selling now for $490. So here we see a purchase that has been discounted. Remember, on our original purchase we recorded a few slides back, we had bought some stuff from Long's Peak Supply, merchandise that is, and the gross value of that was $2,500. They didn't at that time offer a discount. So if we throw in a discounted option for this particular inventory that we're purchasing, and if the terms are 3/15 net 45, that means as long as we pay them within 15 days, we're going to get a 3% discount. So a 3% discount on $2,500 represents $24.25 as our merchandise inventory value, and the amount of our accounts payable, $75 was taken off. 3% of $2,500 is $75. So we would record this as a debit to merchandise inventory at the discounted amount and show that our accounts payable is $24.25, the discounted value there. Next topic, credit and debit memos. So businesses that offer merchandise on account or otherwise oftentimes receive that merchandise back because the purchaser did not want it or for some reason it didn't meet their needs. And so when merchandise is returned, we have these credit memos that are issued and debit memos. So there are two sides to this. When we are the seller and the buyer returns merchandise to us that they no longer need, we issued the credit memo, and that memo states that we have received their inventory back and they no longer owe us that money. The other side of that would be if we were the purchaser and we bought some inventory and decided we didn't need it and we sent it back, and that company that we send it back to would issue a credit memo that would say that we have received the inventory back and you no longer owe us this money. Now, the term debit memo comes into play here because when a company issues a credit memo to us on our side of the fence, that really technically is a debit memo. So we're going to see how this works, how credit memos look, and what the journal entries are that are required to update our inventory accounts and our accounts payable or our accounts receivable as we process these credit memos. So as I've already stated on the previous slide, the credit memo by a selling company is when merchandise is returned to us and we let our purchasers, our buyers, our customers know that they no longer owe us the money and we have received the inventory back. This might be an example of what a credit memo from a company could look like. It says clearly at the top that it's a credit memo. It looks a lot like an invoice, except it's a credit memo. We can see here some clarification that in this particular example, the company that was the selling company and the one that issued the credit memo is a company called Beach Bowling Lanes. The company that is being given the credit is a company called BK Sports. So BK Sports originally bought a couple of bowling balls from the supplier, Beach Bowling Lanes, and they didn't want them and sent them back. And so this is the credit memo saying we've received these 5 bowling balls back and you no longer owe us some money. There's notations at the bottom of this for student purposes that because there was a discount available on this sale, the $375 has been discounted to $367.50, and that should be the amount that we record when we journalize this credit memo. $367.50 is no longer owed by BK Sports. The other note here is on the left at the bottom in the yellow line shows that those 5 bowling balls cost us $196, and so when we return them to our inventory, we need to make sure that we value them at $196. So if we move on now, we can see a journal entry of a typical credit memo. This would happen in our general journal. We can see that we debit an account called Customer Refunds Payable. That is a contra liability account, which we load up and make a guess up front that we're going to make some refunds. And we'll learn more about contra accounts when we get to accounts receivable. But it's an account that we use to keep track of refunds that are being paid. You'll notice that the amount there was the discounted amount from the invoice at the bottom, the $367.50, not the gross amount. So we debit that account and we credit accounts receivable for BK Sports, showing that they no longer owe us the $367.50, again, the discounted amount. You'll take note here of this posting reference. Since we're dealing with subsidiary ledgers in some cases, not all cases, but in some cases, if we have a subsidiary ledger for accounts receivable, we need to update our accounts receivable in two different places. One, in the subsidiary ledger, showing that BK Sports no longer owes the money, and two, in the general ledger. So we have split this posting reference in half, and showing that the check mark indicates a subsidiary ledger was updated, and the account number 112 for accounts receivable shows the general ledger was updated. Now, this particular process may not apply to all students, as subsidiary ledgers may not always be used, but some students do use subsidiary ledgers and would need to update accounts receivable in two places. The debit to merchandise inventory shows that those bowling balls are going back into inventory, again at their cost, $196. And this estimated returns inventory, again, is a special account that we use to track returns for inventory, and that's the account that gets credited in this case. Both the customer refunds payable and the estimated returns inventories are accounts that get recorded in adjusting entries at the end of an accounting period to be used in future accounting periods. And we'll learn more about that type of stuff again in Chapter 9 when we're talking about accounts receivable. But for now, just know the account names and this journal entry that may be required to be recorded for a credit memo when a seller issues it to a purchaser or a customer. When credit memos are issued by suppliers to a purchasing company. So this would be in the case where we purchased inventory, no longer wanted it, and sent it back to a supplier. And so they would issue a credit memo that might look something again like this as an example. The credit memo is from Pikes Peak Supply. It was from Outdoor Supply, issued to us. The name of our company is Pikes Peak Supply. It's a credit memo from Outdoor Supply. We would consider this at Pikes Peak as a debit memo. Okay. There's some information on here. What's being returned are a couple of kayaks. The original purchase was $300. They did offer a discount of 2%. And so what was owed by us to them was $294 for these particular two kayaks. And so now that we have that information, we can show the journal entry that would be required when a purchaser, us, returns merchandise to a supplier. And so this is, we no longer owe them accounts payable. The name of the company that was owed to was Outdoor Supply. So accounts payable for Outdoor Supply for $294, and then credit merchandise inventory to show it's no longer in our inventory. As we had an example earlier with accounts receivable where we used a subsidiary ledger, if subsidiary ledgers are used for accounts payable, we would have to update the accounts payable in two places. One, the subsidiary ledger, which is the check mark, and two, the general ledger, which is the account number 211. So we divided the posting reference in half diagonally and showed both of those posting references. All right, enough about credit memos. Let's move on to the topic of freight. Okay, so freight, there are issues with freight, and one of the issues is while inventory is being shipped from a supplier to a purchaser, a merchandising business, who owns that inventory while it's on the truck or on the train or on the boat? Is it owned by the selling company or is it owned by the purchasing company? Another issue about freight is who pays for freight? Is it paid for by the selling company or by the purchasing company? And so they don't have to be mutually exclusive, as it says here. You could own the inventory but not pay for shipping, or you could not own the inventory but be paying for shipping. So we have some terms that we're going to introduce here on the next slide, but who pays for it and who owns it are two different issues that need to be understood by the two companies. All right, so if we look at this invoice here, we see that some company called Wolf Hardware sold some stuff to a company called Mountaintop Hardware. And what was sold were some bath cabinets and some faucets. And here was the amount of the bath cabinets, $4,800 total, and the faucets, $700. But then if we move down here, there's a term that says freight charges, $400. So what has happened here is that Mountaintop Hardware has to pay the shipping charges for this inventory, but Wolf Hardware paid it in advance and then billed Mountaintop the $400. The total invoice for $5,900 is all inventory. So in other words, the note here is that if you pay for freight as part of your inventory, it is included in the total cost of your inventory or your cost of merchandise sold. So the inventory alone here was $5,500. The freight charges are $400, but the value that we put on our inventory is the total of all that, or $5,900. So the other issue was freight was who owned the freight while it's being shipped. And so there's some terms here: free on board, FOB, shipping point. Okay, so in other words, you see on the left a factory who manufactured some goods, and you see on the right a store who's going to put those goods in their store and sell them. And then you see a truck that's going to take them from the factory where they were produced to the store where they will be sold. And the question is, when they get on the truck, who owns those items? And if the terms are free on board shipping point, then once the inventory is on the truck and out of the factory, it is owned by the people at the store, the retail outlet. Okay, free on board shipping point. And so you can see there's a rose-colored rectangle there that shows that the store owns the inventory while it's on the truck. Now, the flip side of that, free on board destination point. And so we see that the factory on the left manufactured this, and while the inventory is on the truck until it is reached at the store and unloaded, it is owned by the factory. So that's free on board destination point. And that concludes the discussion about freight. Now we move on to yet another topic known as shrinkage. And so inventory is an asset, okay, and it has value. And so every so often at the end of an accounting period, either at the end of a year or the end of a quarter, there needs to be a physical count of our inventory so that we know exactly how much we have. Our records may indicate one thing, but because of shrinkage, which means lost or damaged or stolen, inventory disappears. And so the value we have on our general ledger books is probably overstated. We have too much there. And so a physical count will tell us exactly what our inventory value should be. And once we know that, we're going to have to do an adjusting entry that will change the value of our merchandise inventory from the current book number to what it actually is based on the physical count. And so this slide will help us demonstrate how that physical count identifies the shrinkage here. So on the left, you see that we have some inventory, and according to our general ledger account, we think we have $25,785 worth of inventory. But in the middle of this slide, we see somebody goes out and actually counts our inventory and determines that no, we do not have $25,785. We actually only have $25,500 worth of inventory. And so we need to do this adjusting entry that will get us from $25,785 to $25,500 so that our books accurately reflect the actual inventory that we have on hand. So that journal entry would look like this. The difference between $25,785 and $25,500 is $285. So we would debit cost of merchandise sold for $285, and credit merchandise inventory for $285. And once those items are posted to the general ledger, we see a T account below, which represents our general ledger. The $25,785 becomes $25,500, which is the actual inventory value that we have on hand. And so there's an adjusting entry for our shrinkage. So that concludes the actual selected items from Chapter 6 dealing with merchandising business. Some of them may apply to you, some of them may not. Don't be confused by the credit memos. If you don't use subsidiary ledgers, you can ignore the double posting process there. But the actual journal entries do apply to everyone. So if you have questions, please contact me. And as always, I'm here to help.